Part 11. Trending Volume Profile Strategies. A market wizard once said, "When the news is wonderful and the market can't go up, then you want to be sure to be short." Welcome back to part 11, guys, and again I hope you really enjoyed those strategies we spoke about in part 10. I hope you're starting to understand now what it takes to develop unique trade strategies and what's required in order to develop real edge, as we spoke about back in module 1. So what we're going to talk about now in part 11 is we're going to start off and I'm going to introduce you to the concept of price action, and hopefully you can understand why professional traders not only use volume profiles as their desired tool, but why they then execute using price action and price ladders. So why do professional traders use price action? Very simply, to perfect entry and exit. Now, traditionally, the retail market would execute using things like CFDs and spread markets and maybe even some futures markets, but you're always effectively paying some form of spread or commission to the broker. Now, as professional traders with access to the futures exchanges, we can effectively execute at the market price. Straight away, this means we're no longer paying spread, and that's one of the most important reasons why we execute at the market. Another very, very important reason is for execution purposes. Remember what I said, every single price and increment is crucial in trading. The difference between the price can mean so much in the big picture. Also, when it comes to very specific trade strategies and you're executing with all sorts of algorithms as well as other professionals, speed is essential. So we need to have access to the actual market and more importantly, we need to be able to execute very quickly and efficiently. These are some of the main reasons why we use price ladder as the desired tool for execution. There are other reasons, and those can be that you can develop very specific strategies just utilizing and watching the interaction between buyers and sellers. As you'll see in the coming example, the price ladder effectively shows us the real volume that buyers and sellers are transacting with one another. So by watching this real volume transacting, you can pick up on some early clues as to who's stronger, what the kind of buying the buyer's doing, whether he's stopping out or initiating new business. These are all sorts of techniques you can develop and learn, with the price ladder, and ultimately this will allow you with your strategies to almost perfect what you're trying to achieve. Now, price action is objective and factual, just like volume profiling. So like we said that we want to be as objective as possible in terms of our strategies, we also the price ladder is as objective as can be. Why? Because what you see is what's physically occurring in the marketplace. Then profiling is the idea, it's the strategy, it's the strategy you're trying to employ into the market. But price action is the idea execution. It's how you actually physically execute that strategy. Remember, if you're doing a strategy like, for instance, a breakout, as we spoke about, it's absolutely essential which price you're entering the market at. This cannot be done with traditional means. This needs to be done with some form of a price ladder at hand. Also, when you're watching the price ladder, you learn to develop what momentum looks like between buyers and sellers. You learn to develop intuition as to how the price is responding. In momentum strategies, the market's going to respond very, very differently on the price ladder to, say, reversal patterns, to, say, just bracketing type markets. So all of this can be learned and taught using the price ladder. Now, note, you should expect to see, in the example that we saw in the breakouts, we spoke about seeing a pickup in volatility and volume. This can be seen using the price ladder very, very clearly, and that is again another important reason why we use the price ladder whilst executing our volume profiling strategies. These are just some of the reasons as to why we actually use both volume profiling as well as price ladders for execution. Let's now go and look at an example of what a breakout strategy would look like in the price ladder, and hopefully you'll get a better understanding of not just what the price ladder looks like, but how we can actually execute on that price ladder to perfect our breakout strategy. Welcome to this special edition where we're going to combine price ladder trading with volume profiling. Before we actually push play on the ladder, let's just discuss some of the reasons as to why traders look to combine the skill set that we develop with the price ladder as well as the various strategies we've developed in the volume profiling course. Some of those reasons would include the following. Firstly, traders want perfect execution. Now this is probably the single most important reason why traders actually utilize the ladder at the same time with their strategies. With the price ladder, we can execute at the market, so we're not paying any spread. We can also manage trades over a period of a day, either adding to those trades or taking away from those trades. We can manipulate our position. And then more importantly, we can perfect the timing as to when we enter and exit the market. The second reason why traders like to use the price ladder with these strategies is so that we can remain objective throughout the process. What do we mean by this? Well, very simply, one of the mistakes a lot of traders tend to make is they take a look at a chart technically, they execute based on that chart, but they don't take into account, what the physical trade is that is occurring or the physical auction that is occurring in the marketplace. So for instance, let's say, we have a key area we want to sell at resistance 1. What if I told you that at this resistance 1, you actually saw buyers were buying those prices? Now with the price ladder, we can actually identify and view the auction process at that given price point. If we were to see buyers where we wanted to sell, we wouldn't merely just sell. We would wait for that buying to finish before executing sell-side opportunities. So by having the price ladder, we can remain objective, not just with our strategy approach, but also with our execution methodology. And the third reason we like to use the price ladder is that in the various strategies, you would have noticed we have various types of execution or various styles of execution. Those can range from being aggressive in nature in the execution or being more passive. Now, in an aggressive type execution, you need to be able to hit the market at the most desirable price. Whereas in a more passive style execution, you want to be executing when the market is giving you the best available price at that given point. Now that is a number of reasons why traders like to utilize the price ladder in combination with the volume profiling strategies. Let's now move on and talk a little bit about the strategy that I'm going to show you in the example provided. Now, we've done this strategy in the Momentum series, and it was strategy number 6. This strategy was the wide initial balance or initial range distribution. Now, cast your mind back. We said the objective of this strategy is to firstly and foremost determine what do we mean by wide. Now, in this example provided, what occurred was we had an overnight move as a result of the OPEC plus non-OPEC agreement. Now, the important thing to understand was, whilst this fundamental was largely priced and expected to occur, the market actually took out some very key technical areas. As a result, we had a $1 gap, but then we also continued higher in the overnight session with a more or less $3 overnight move. Now remember what I said. The key to interpreting this trade strategy is to first and foremost know what the average range is in the overnight session. In this case, it was somewhere between $1 and $1.50. So as you can see very clearly, we had, in terms of this example, we had a $3 range against the current average of between $1 and $1.50. So a really, really wide overnight distribution. Straight away, this brings into play the wide initial balance distribution strategy. Now, the basic strategy execution was we look to fade into any momentum that takes out any one of the extremes. In this example, it's obviously to the upside. As you can see on the chart, 54.52, that was the overnight high. Now, what we're looking to do is we're looking to sell into any momentum that comes into this high or extends this high and fails. that is when we look to enter shorts aggressively, looking for a distribution type play. So if we got anywhere around this 54.50, tried to extend but failed, or retested and failed, we would look to target and trade that back down towards the 53.64. There, in terms of risk, we merely put our stop above the failure point and execute accordingly. Now, let's push play and go through some of the metrics of the price ladder before we actually go through the live price response. So as you can see, in the price ladder, in the blue boxes, we have got all the bids. Now, these bids are where market participants are bidding at various prices. As you can see, we have the varying prices in the middle of the price ladder. On the red side, as you can see, we've got all the offers of market participants looking and willing to sell the market. Now, the important thing to look at is what the physical volume being traded is in the column shown. And more importantly, what's being traded at each price that trades. Now, over the course of the day, traders will watch the price ladder to get a feeling for when there's a sudden shift in volatility. Now, we've spoken a lot about, why we open up various profiles, and the more important is when we can see a sudden shift in volatility. Now, in the chart provided, if we look at this small little area, you can see how the volatility shifted once we had the Y print. And that is why we're starting the ladder around this point, because there's been a sudden shift in volatility in the market, and that's why we sort of want to sit up and pay attention as this market is almost woken up. So let's go through the price ladder and watch now how the buyers and sellers begin to interact with one another. As you can see currently, the market, there's a lot of two-way trade occurring. We can see buyers bidding 20 at 23, but equally buyers lifting the 24s. Now, what you want to pay attention to is the sudden shift in the price response that is occurring. So traders learn to develop various skills on the price ladder to determine when there is a sudden shift in the way buyers and sellers are interacting with one another. Now, important to note is that, yes, we can see it visually on the chart, but once we've seen it on the chart, visually everyone else can see it as well. And it's for this very reason that traders tend to utilize the ladder, as it gives us leading information or forward-looking information, as opposed to what we see on the ladder, which is backward information or information that has already occurred. So let's join in and have a look at this price ladder and try and identify a few things. So what we've seen over the last couple of minutes, if you've been watching very closely, is that we've seen a buyer step into the market around the 21s. Let's rewind this slowly and have a quick look. So if we go back, we will notice that for the last couple of minutes, we've seen a buyer start and step in around the 21s. That buyer is looking to obviously fill a position. Now, the manner in which he is executing in this example is he's looking to buy at a price, and this price is 21. Now, the minute that seller no longer wants to sell to him at 21, he then looks to buy 22. And the minute the seller stops offering and reloading the offer, he looks to buy 23 and 24. And all of a sudden, we can see a relatively large bid come into the market. So we can see that not only is this buyer, hoping the seller will sell it to him, but equally, this buyer is becoming a little more intentional and aggressive in the way he responds. And we can see that not just with the fact that he's lifted the 5s, the 6, the 7, and the 8, but we can also see it with him posting relatively larger bids. Now, the important thing to watch when looking at price action is to determine, is the market moving up like that as it goes over a series of prices, or is it moving up like that? In this example, you can see we've suddenly moved very quickly from the 22s all the way up to the 34s ever since that buyer came in and posted 124 contracts at the 26s. So we can see the sudden shift in price response, we can see the aggressive nature of the buyer stepping into the market, and we don't need to look to the chart for that information. We merely look to the chart for confirmation of what we already see in the price ladder. again, the price ladder is forward-looking, allows us to remain objective. Now, our trade strategy is simple. We are looking for the market to come in and retest the 5450s. Remember what we said. We're looking for momentum into the previous extreme that we can then sell. So the minute we see momentum, we want to be going against that momentum and ensure that we manage our risk. First and foremost, we always manage our risk in this trade strategy. Don't forget also, we have relatively good downside opportunity in terms of the strategy. We're looking at roughly 80 prices. So how much risk are you willing to take to capture those 80 prices? Now, as you can see, we started off with the oil around the 54.21, and we've now moved up all the way towards the high of the session. We're now trading 54.50s, having started at 54.22s. Let's now go and have a look how this momentum is created. But more importantly, remember what we said. We utilize the ladder to ensure that we sell when sellers step in. We don't want to be selling now. Why? Because there are still buyers in the market. We need to remain objective and honest. We sell when a seller steps in, not sell while someone is still buying the market. So let's see if we can capture that point where the actual seller steps in. Note, buyer still buying 3 and lifting 4. Again, the buyer happy to take the 4 and happy to get sold, something at 4, and he keeps buying and buying and buying, looking to constantly fill out his buy order. Note, when the buyer doesn't get what he wants at the 3s, what does he do? He goes to the 4s. So the seller sells to him, but equally the buyer buys from the seller. Again, we can see, based on the price ladder, that the buyer is still in control of this situation. Note, technically, we are approaching that 54, 52, 51 area. Again, we saw the buyer reloading the 2s, lifting the 3s. He's now reloading the 3s, lifting the 4s. He's now reloading the 4s, and he's likely to lift the 5s. So we're still seeing relative strength being shown by the buyer in this example. So we have still not seen the seller take control. As the minute we do see that seller take control, that's when we execute against the momentum. Again, we can see the buyer holding control, reloading the 2s and lifting the 3s. Still the buyer continues to hold control. Note, another 100 lot. Remember the previous 100 lot we saw? That created the last bit of momentum. So we've got an early clue. The market's given us a clue that suddenly this buyer is becoming more aggressive again. We switch on, we pay attention. Buyer lifts 4s and goes straight to the market to buy the 5s. Buyer's happy to get hit at the 4s by the seller. He's happy for the seller to sell it to him, and he lifts the 4s. So again, we're expecting a little bit of a flurry now. Why? Because the market's giving us some forward information as per the price ladder. Now note, the charts or the distribution will never show us this 130 lot. That, again, is another important reason why traders utilize the price ladder. It gives us early information. So again, notice how the buyer is buying ahead of his own order. And again, the market is lifting the 4s. Let's see what happens now as this buyer gets filled. So what we can see there is the buyer actually got filled. If we look in that right side, we can see the buyer really wanted those 42s. He took all 100 contracts at the 42 area. Very important, guys, because if there's a buyer taking this much volume around the high of the day, again, it's telling us that the buyer is still in control, but equally, someone sold it to him. And the mere fact that someone sold 100 contracts at the high of the day is telling us that the sellers are actually not weak and they are taking advantage of the higher prices being advertised. Let's see now if we can capture where the sudden momentum shift occurs. Remember, we've now seen buyers in control, holding the bid, moving the market up from 54.21 up towards 54.46. We had two key price ladder hints coming at us. We saw 120 lot lower down, which didn't trade, and the market very quickly moved away from it. We then saw another 100 lot come onto the bid at 42s, but this time round, someone actually sold it to him, and we didn't see the aggressive nature as we saw previously. So we've had a sudden shift in what we saw down at 54.21s and 54.42s. Two very different auction processes have occurred between buyers and sellers. Again, the ladder or the charts won't always show this very forward-looking information, and this is why we utilize the combination of the two trading tools. Now, the market has come in and retested the previous high of the session. Let's take note of what occurs now. The market's trading 45. We can see someone is selling it into the 45s, but equally the buyer is happy to keep reloading the 45s and trade the 46s. Okay, we rejoin this price action now, and we can see how suddenly the market's come, it's retested that high. We've seen a little bit of momentum coming into this high, and all of a sudden the seller has started to go firm on his offerings. Equally, the seller is now not just firm on his offer, he's hitting the buyer and hitting the buyer, 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 constantly becoming aggressive. So as you would have noticed, we had that slow grind around the highs. Suddenly, we retested the previous high and the seller became aggressive. Prices had reached a premium, and we've moved very quickly lower ever since we traded up around the 54.49. I hope you can see the difference just in this basic example of how we've had three different types of price responses between buyers and sellers. Firstly, we had a buyer panicking, looking to be more aggressive. Then we saw a lot of two-way trade response between buyers and sellers as we moved towards the previous high of the day. And thirdly, we saw once the market advertised, premium prices, a seller stepped in very aggressively. Now the execution is simple. We've seen the sudden shift in momentum. We are now looking to execute aggressively where a seller allows us to get involved. As you can see here, bang, the market has briefly paused. It's taken a little bit of a bid up. We are now looking to execute our trade strategy with a stop above the high. So we enter the 39s and the 40s. We put a stop at the 52s, and we're looking to target all the way down to the 64s. Notice how we've used the combination of the price ladder and the various strategies you get using the price ladder. Also, notice how we've taken a strategy that we've developed over time and incorporated it and utilized the two different skill sets together. Now, important to understand, it takes time to develop strategies, technical strategies using the volume profile. But equally, it takes a lot of time to also develop various price ladder skills. Let's now fast forward this and see what occurs as we move the price forward. As you can see, the market continues to move lower and lower and lower and lower and lower and lower as the seller has now taken full control of this auction process. Let's now wrap up and summarize. In summary, it's imperative to not only have volume profiling strategies, but equally utilize the price ladder because of all the advantages we've already spoken about. What occurred in this example over time is that the market eventually filtered all the way down and retested and gave us our exit. More importantly is that if you go look at a chart from this date, you will find that actually this was the high in the oil for not just this day, but also for a couple of days. So almost 2 weeks this high held. Now, what is important to note is that whilst we, didn't necessarily hold on to this trade for that length of time, we did utilize our strategy and execute it accordingly to what the price ladder was showing us. This then wraps up our example of how we use the price ladder and the volume profiling in combination. I hope you've enjoyed this video.
This is a very important part of part 11. The trading secret. Now, I'm not going to tell you what the Holy Grail is. I'm not going to pretend that I could ever teach anyone to trade. My objective as a mentor is to guide you to understanding principles so that ultimately one day you can teach yourself how to trade. Skill development doesn't come from a book or a teacher. Skill development comes from you yourself. So what is the trading secret? It's very simple. You only need one strong trading edge to make very large sums of money. Let me repeat that. You only need one strategy to make very large sums of money. Now, a lot of you may be sitting there thinking, how's that possible? Well, let me tell you, the secret that day traders, that professional traders have kept from the retail market and many around them is that we know how to employ leverage. We sit there all day watching price, watching how it responds, watching the interaction between buyers and sellers, and the minute that interaction changes, we're able to shift and employ leverage to take advantage of the change in price. Now note, day traders have multiple strategies. Why? Because sometimes a strategy can go cold. That's why I've given you 11 unique strategies. At times, some of them are going to work extremely well. Momentum strategies are going to be in play for periods of time, and all of a sudden they're going to go cold. And that's when we want to shift between momentum strategies and maybe move more towards anomaly type strategies or reversal type strategies. The art is to knowing when to move between the various types of strategies. Now note, we only need one strategy to master in order to be successful. You don't have to be a jack of all. Get it out of this idea that there's 101 strategies. There isn't. With the 11 strategies you're going to learn in this module, you can become a highly effective trader. You only need one strategy to become a master of the markets. One good trade. Now, before we get on to the trend type strategies that we're going to develop with you in part 11, let's try and define them in terms of those key characteristics again. So first and foremost, what sorts of time frame participants can you expect to see in trend trading strategies? Well, the big difference between trending trade strategies from momentum trade strategies is that trending tends to be initiative time frame only, and it involves all time frames, just like the momentum strategies. But the major difference is that when we see initiative in this one, it's initiative from all time frames. So everyone is either buying or everyone is either selling, and we get very little other time frame type participants. Remember what we said in momentum based strategies. Sometimes the momentum can be created from a responsive other type frame that is being forced out of their positions. In this case, yes, there are some other time frames being forced out of their positions, but everyone is going in the same direction, and that's why this momentum is a lot more continuous. Now, in terms of the time objective, trending tends to occur over not just a couple of sort of moments of the day, but for an entire day, a couple of weeks, and sometimes even months and years. So it's important to understand when the markets are in a trending type condition, so that you can employ your trending strategies not just for a couple of hours in the day, but days and potentially weeks. In terms of volume and volatility, we tend to see heightened volume and heightened volatility, as well as range expansion during trending trade strategies. So note, when you see relatively large shifts in the volume and ranges and relatively large changes, you want to be aware and you want to begin employing trending type strategies. We then also talk about risk and reward. In trending type strategies, the risk and reward is unlimited. If you get involved at the right areas with the right trade location and you interpret the beginning of a trend or even the middle phase of a trend, you can take risk reward that is beyond imagination, because in a trending type strategy, the market will keep going and going and going until it manages to run into influential responsive type other players. In terms of momentum, it's crucial that you again interpret this sort of a trade category quite early on, because the momentum is relatively aggressive and continuous for some period of time. Let's now try and define momentum a little bit better. Now, momentum means pretty much price discovery mode. It's when the market moves away from fair value and it begins to move in the direction of price discovery. We tend to get very little price overlap. So when there's momentum in the market, we don't see much overlap of price. Prices hang around for a little while before progressing with the momentum. Reference points tend to have very little technical importance. So if ever you see a market sort of taking out a lot of key technical areas or key reference points you had identified, that's a very early identifier that there is momentum in the market and flow. We tend to see one-time framing when there's momentum. Also, all time frames initiate in the same direction. So true trend-like momentum, everyone is in agreement as to price direction. And lastly, just be aware of the bias trap. In other words, what often happens is when there is momentum or trend in the market, we tend to get almost stuck in a rut that a market can only go one way. Now, whilst this is a very good thing in a sense that if a market's trending higher, we only initiate buy side trades. We always need to remember that there is always a risk attached to whatever we're doing. It doesn't matter if a market's trending higher. There is always the likelihood or the probability it could reverse and reverse very quickly. So when you're employing these trend-like strategies or there's strong momentum in the market, always have what we like to call a line in the sand. And this is the point at which the momentum or the trend is no longer valid. This is the point at which you have to snap out of the sort of momentum craze or the bias that's been going on and just protect yourself. So, we're going to talk about 3 basic strategies when talking about trend trading strategies. They are trend days, day 2 of trend, and then engulfing profiles and value areas. These are going to be our 3 trend trading strategies which we are going to talk about and discuss and annotate over the next couple of slides. This is it's one of the most unique sets of strategies because it looks it sits out on the chart like a sore thumb, and you can do very well in these types of days, and the psychology behind these day types is also fascinating to understand. So let's get into it and let's just talk a little bit about trending trade strategies. So firstly, we spoke a lot about control identifiers in the momentum series, and what's important to understand in the trend day is that the control identifiers will all be existent. So a lot like we saw a lot of them in the momentum series, they're going to be in the trending series as well. Then, very important, when we do have not just a trend day but trending strategies, note all time frame participants are trading in the same direction. So we spoke a lot about these participants in module 2, and it's important to understand that when a trend day is there, we are seeing not just the day trader, the algorithm or the swing trader, but also the larger influential players all trading in the same direction. And it's this sort of confluence of time frame participants trading in the same direction that creates the very aggressive nature that is trend. Now, another important aspect to definitely talk about is this is a infrequent occurrence. So trending doesn't occur that often. I mean, sometimes it could be 5% of the time, sometimes it could be 25% of the time. But markets don't trend as much as they do, as we would like at least. And most of the time they are spending consolidating and bracketing. So this is why the trend day tends to catch people off guard. However, I'm going to show you some of the key characteristics about being able to sort of pick up on a potential trend day early on. Then, in terms of the emotional aspect, I want to deal with this first because it's important to understand the emotions, not just in the trend day, but in all the trending strategy. With the idea that we don't trend very often, we tend to see when a market does trend, we tend to see almost, traders being a little bit almost upset with themselves or almost a little bit sort of down on themselves, feeling like they've missed out on a massive opportunity. And understanding this is important because it's okay to miss the initial part of a trend day. What isn't okay is, number 1, to go against a trend day. But more importantly, number 2 is to become aggressive and suddenly start mismanaging your trading because you've missed the early initiative. What I will say in general, Traders that can keep their head and not be sort of too anxious that they've missed the initial move can still get on the latter part of the trend day. And that is the key to not just this strategy, but to all trending strategies. Do not panic. The market will give you a chance to hop on the trend. But first you have to identify that there is actually trend. Now, what's important again also to discuss is the risk element. In terms of money management, you can afford to have a slightly skewed risk reward. And the reason is that if there is perceived trend in the market and you've seen all the characteristics, you have to remember trend by its very nature equals a lot of opportunity, so a lot of potential reward. So don't be afraid to have slightly bigger risk when it comes to trend strategies. And again, factor that into your emotional analysis. If you're someone who doesn't like wide stops, well, you need to try and sit down and visually understand why it is you're taking these wider stops and learn to manage that accordingly. Then also, in terms of expectation analysis, don't forget that when a market does begin to trend, it occurs for most of not just the session, but for a couple of sessions. So again, you need to expect this trend to stay in the market for some time. Don't just jump off the boat, because suddenly we're seeing a little bit of a pullback in the trend. So again, factor that into your expectation analysis. Now, what we want to talk about is the phases of trend, the various different phases you'll find in a trend. And the best way to talk about these phases is to actually graphically depict them. So we've got the early phase, the mature phase, and the late phase. Now, I'm going to use a basic consolidation pattern to explain to you the different phases. Now, let's say the market for a couple of months has been moving between these barriers and these reference points of S1 and R1. Now, once that market eventually breaks the consolidation bracket and begins to move out and trend, showing a lot of control identifiers, momentum, volume, and volatility, that is regarded as the early part of the trend. Once the market has done its move and has its first pullback, and this can be a couple of days after, but once it has that, finds those responsive sellers in this example, the second leg up or the second initiative move is our maturing phase of our trend. Once the market then has a second pullback and then extends for a third time and starts to see a lot of two-way overlap, that is our late part of our trend. Now, the importance behind understanding this is at which point are you in the trend. So a trend day can come anywhere, guys. It can come out of nowhere a lot of the time. But the important thing to understand when you see it is at which point or at which phase are we at. And the reason is, if we are at an early phase, we are likely to see a very different price response than if we are at a late phase. Now, I'm going to show you two different types of example. One will be, maybe a more early phase, and one a more mature phase. And you will see, obviously, the reward and the aggressiveness of the move looks a little bit different. Now, the important thing to understand is that, depending on where you are, early, mature, or late, this will effectively tell you the strength of the trend and how aggressive you need to be. So just some of the basic characteristics of a trend day is, first and foremost, a little price overlap. So as you can see in this example, note the lack of overlap in price. So the market barely overlaps until we run into some responsive buyers and the market finally bounces. That is very typical in a trend move. Then, a pure lack of respect for levels. So what you'll tend to find is that, as you map out a market, when it starts to trend, the reference points are almost completely ignored. They're almost disrespected. Any kind of, maybe you had, a key support 1 level or a couple of really big points where you thought buyers should, actually respond. That, when they don't get respected at all, that is a very early observation that there is potential for trend in the market. And then the usual volume, momentum, and range expansion. So as you can see, very little smaller ranges, and all of a sudden we see much larger volatility and range expansion in this market. So those are the key identifiers that you will typically find at the early parts of a trending move. Now, what I will say in terms of the execution is that it's relatively simple to execute a trading strategy based on trend day. However, not many execute very, very well. Why? Because they grow impatient and they forget to, that you still have to manage and execute at good areas, and they tend to get stuck in bad areas. So what you would likely find is that, people tend to start finally hopping on the trend very, very late. That's when you get the initiative final flush out, and then the market reverses and people don't, quite make what they should. So the important thing to understand is when you see, the early identifiers, the single prints, the open drive, the continuation below the initial balance, you want to be entering early and taking your risk early ahead of the move. Again, like I said, if you miss the initial move, that is fine. If you miss this entire move, that is fine. Rule number one, though, do not sit there buying, because that is breaking the rules of a trend day strategy. Rule number two, do not panic, because the market will give you an opportunity. As you can see, it will pull back and reward those patient enough to get involved. In terms of risk, well, we always want to be putting our risk at the point that proves the trend day no longer effective. In this example, above that sort of pickup in momentum and volatility, that point of 21.12, that is where we want to be stopping out. Let's now take a look at another example that we found in the German Bund. As you can see, this trend day came from an inside day break, and notice how the market, once it broke, left early control factors, some low volume areas, some single prints, and again a second set of low volume areas. So we can see how this market has shown us the early identifiers, but again, notice how if we were patient, if we missed the first initial move, the market came back, gave us the entry for opportunities for long, and more importantly, if we managed to sit in the trade and be patient and give it time, it gave us the ultimate opportunity. Now that we've discussed the trend strategy, let's go and have a look at the replay series and find where the perfect entries are, how we can perfect our timing, as well as some of the characteristics you can expect to see. So welcome guys to the replay series for strategy number 7, the first in our series of the trending strategies. Possibly the most effective strategies is the trending strategies. The only caveat to that is that the markets rarely trend. If you were to take a rough estimation as to the probability of how often markets actually trend, you're probably looking in a region between 20 or 10 to 20% of the time. So that's the first and most important thing to remember, is that this strategy doesn't occur that often, and by that very nature, this strategy tends to catch most traders off guard. Now, the reason I've selected this strategy and why I'm going to go through an example with you in a lot of detail is that the strategy has some very, very early clues and identifiers. And if you pick up on these clues and identifiers early, not only will you be managing your risk well on the day because you won't be going counter to the trend, but more importantly, you will have almost the entire morning session, or at least the first half of the day, to identify that there's trend in the market, and hopefully then not have done too much damage going against it, but more importantly, having the opportunity to get on the trend and make a day. So that's the first thing to understand with the trending market. So they don't happen very often, so they are relatively rare. Now, one of the more important things to interpret is whether or not this trend is being created by fundamental reasons or by technical reasons. Now, the reason it's important to decipher and differentiate is because the major difference between a trend creating by fundamental news or technical news is that when there's a fundamental in the market, let's take for instance, we have a OPEC agreement, as this was a recent example. Now, because of that agreement, the trend is created by a very volatile move. What do I mean by that? So new information has hit the market. We see very aggressive initiative being taken by all time frame participants. Now, what you have to remember is that when there is new news and information, there is highly likely there are positions that are positioned against that new news. So what tends to occur when there's a fundamental trend is it is extremely or almost excessively volatile. Now, this is important to understand because when there's excessive volatility, it can be particularly uncomfortable with regards to managing size effectively or risk management. So remember, first and foremost, our job is to manage risk effectively. So we can do that by interpreting if this is a fundamental trend or if it's a technical trend. Now, if you were to compare, say, a technical trending move, these are a lot more powerful and they're a lot more enjoyable to trade simply because they don't have this excess volatility and you can size up quite nicely on them and manage risk quite well. So that's why technical fundamentals tend to be a little bit easier and better to trade. But do remember, the flip side to a fundamental and the advantage to a fundamental trend is that it pays out quicker. Okay, so you have to sit and trade for a far shorter time, so you do get paid for taking on that excessive volatility, but it is a more uncomfortable type of trend. So that's the first thing to interpret when it comes to what type of trend day. Now, what we're going to do is we're going to play this example through. What we have here is the German Bund. Again, you know, as I showed you in the slides, you can find trending in any markets. It doesn't matter. The important thing, and this is what I'm going to show you, is to understand the characteristics of a trending market. So what we have here is the German Bund 10-year, and let's hit the replay button and see what this looks like. So first and foremost, what you need to understand about a trend day is that there is a high probability, that we are going to see the trend occur within the early part of the day. Okay, so what do I mean by that? Within roughly 2 to 3 hours of the session beginning, you will know that we are in a trend day. And that's the important thing. Markets don't trend at the end of the session. They tend to trend from the beginning. So a traditional trend day, the first characteristic is that we're likely to see trend very early on in the day. Now, in this example, we can see a relatively muted open. Small initial balance, no early clue there, guys. Nothing major sending out a clue. We then get our first signal on that imprint. Why? We get an engulfing candle of the previous candle. So we can see very early on the imprint gave us a little early identifier, an early clue. But again, note a real lack of volatility, nothing really going on, nothing to suggest that suddenly this day type is going to be a major market move. Now, the P print comes, and note again the double bottom on the P print, and suddenly we take out the initial balance high. Now, nothing at this point suggests that we are in a trend day. We've been trading for just over 2 hours of the session, and for all intents and purposes, it's just a normal day type. Now, what we want to identify is what are the early characteristics or the early clues that there is potential for trend. Now, the first one we can identify was one, yes, the engulfing imprint. Now, the second one that has the potential is the failure of the market on the Q print to re-enter the initial balance. And the third, and what we're likely to see now, is this, which is the low volume area and single prints. One of the earliest identifiers of a trend day is where the market leaves a set of single prints and a low volume area. And we can see it quite nicely here on the closed up profile. So we can see the market distributed early on, it's then broken out, and again forming a little bit of a higher distribution. Now, a lot of people would argue that this could still be a double distribution. Yes, of course it could, except for one factor, the time. So we can see that this is still very early on in the session. The market is leaving these single prints, but more importantly, it's shifting value. Note from there's the VPOC first up, we then shifted the VPOC up to there, we then shifted the VPOC up to there. So we can see the market constantly rotating this VPOC higher and higher up the page. More importantly, notice how the market, whilst it's distributing and accepting value higher, it is leaving an untraded area. Now, if this was going to be a double distribution day and not a trend day, we should not extend upon this high aggressively. And note the market extends upon the high and starts to move toward higher prices. So again, if you look on the left side and we look at the auction process, notice how little, how we have an initiative move and then a little bit of overlap. We have an initiative move and then overlap. And that is the key to a trend day. It's constant initiative, but we get initiative before running into responsive sellers. We get initiative before running into responsive sellers. Initiative, responsive sellers, initiative, responsive sellers. So that's one of the key early identifiers of a trend day. Now remember what I said to you. Let's say, for instance, this was later on in the session or later on in the day. The important thing to understand is that this might, you might have missed a lot of this. You might not have, if this was now 12 in the day, you're looking at this thinking, well, I've missed out here. But the important thing to remember, guys, is that a trend day lasts the entire day. That's the important thing. It will remain in the market for the whole day. So if you get to the middle of the day, you do your analysis, you do your debrief, you look at this, you annotate it, you say, bang, low volume, initiative, responsive, initiative, responsive. You can see this trend. So what you need to be looking for in the afternoon is some sort of a buy-side trade, looking for the next initiative leg up, and then covering and selling once we get the responsive selling again. That's the key to the trend day, guys. It's not one of those days that, you're not going to bang from the open, get on it and get the trend, okay? That's very unlikely to occur. What you can get on is what we've just seen here, which is a nice long on the A print, gives you the chance, bang, we get the initiative, to the upside. So again, notice how the market now starts to accept value higher again, leaving a low volume area, So all very, very traditional characteristics of a trend day. Now, just one thing to talk about, just note, whenever we get the breakout, whenever we get the initiative, like on this R print here, like on the V print, and like on the B print, notice the volatility. Okay, we can see a lot of range expansion every single time we get that initiative. And that's created by none other than the person who's executing in a trend-like manner is executing over the entire day. And what they're doing is they keep buying the market until they can find a seller. When they find a seller, they stop buying. They then continue to buy the market once the seller disappears until they can find another seller. And likewise again until they find another seller. So it's that initiative move that we want to be on. That's where we want to be executing. We want to be on those V prints and those B prints, and again the next leg higher. So we want to be on the initiative move. That is where our execution comes in. Now in terms of managing this trade, this is key. Okay, you need to believe in the trend day. The minute you see these single prints, the minute you see this initiative and two-way trade, you need to be executing, note, at lower prices. So you want to be executing in this area. You have to be careful getting sucked into buying into this area or buying into this area. And the reason is that if you buy into these aggressive highs, okay, what could likely happen is that you've missed this move and your psychology says, bang, I've got to get involved up at the top here. And note what happens. For almost an hour and a half to 2 hours, the market moves sideways before the next leg, and then another bit of sideways, and then the next leg. So if your timing is marginally off, you're buying up at these prices and you're paying down. That's why, remember, you want to be accumulating at lower prices and at lower prices and at lower prices. Keep passively entering the market at lower prices. Don't get caught up and get sucked into having to buy the higher prices, even though the trend is to the upside. Now, two things to understand with regards to a trend day. Picture yourself being a seller in this market. All right? Picture yourself selling it here, or selling it here, or selling it here. what do you think it would have felt like had you sold on those points? Okay, the simple answer is it wouldn't have felt very comfortable being a seller at those points, and that's the important thing to understand with a trend day. It rewards the buyers. Okay, it's a hard trade to be a buyer when we've just done that, and when we've just done that, and when we've just done that. It's hard to be a buyer. But that's why it pays the buyers on this day type and it punishes the sellers on this day type. So that's the important thing to understand with regards to a trend day. And then lastly, guys, and what you need to focus on is in terms of the close. Okay, the close is quite key. Where the market closes will tell us, what is likely to occur potentially on day 2 and 3 after a trend. So that is effectively our trend day, a very aggressive trade setup, a lot of opportunity in trend day, and there are some very easy identifiers. Just remember, again, if you find enough examples of what trend days look like, you will see that these characteristics of single prints and initiative and all these sorts of things, they tend to occur time and time again. So find yourself enough examples of this that you can learn the strategy and then become highly effective at executing the strategy. This concludes then our strategy 7. Next we can obviously move on to the day 2 trend, and you'll see how it will look as we go forward. Remember, practice makes perfect. Welcome to the second strategy in the series of trending trade strategies, and what we're going to talk about here is the day 2 trend. Now, this is effectively, the name comes from the mere fact that we are, after a trend day up, we are merely on the second day after a trend. Now, the day 2 trend is a wonderful strategy for a number of reasons, but most importantly is we have got an entire overnight session to prepare for the day 2 trend. So you've got a lot of time to almost prepare how you're going to manage and execute your trade strategies in the day 2 trend. Now, why that is quite advantageous is because the day of a trend is notoriously known to be quite volatile, and quite a lot happens that brings out, that forces almost a trader to respond very differently. And remember, trend days occur quite infrequently, so they do tend to bring up different, they do tend to test different skills that a trader has when we do have a trend day. So it's quite nice to have a little bit of time just to assess and have a think about how we're going to execute the day after a trend. Now, the important thing to understand before we go through the different variations of a day 2 trend is effectively, what types of trend days do we get? Now, the 2 types are the fundamental trend day and the technical trend day. Now, the reason these are important, as you'll see in a second, is that they create potential different variations of what can occur on day 2. In essence, when we have a fundamental technical day or trend day, the day 2, there is a much higher probability of a secondary trend day as opposed to if it was a technical trend day where there's a higher probability of a distribution type day type. So with that in mind, let's have a look at some of the variations of a day 2 trend that you can expect to see. Now, the first and most likely of the day types is where the market, we have the trend day on day 1, and then on day 2, the market attempts to extend the trend, it fails, and then distributes in the higher end, in this example, of an uptrend. Day 2, the second example would be where the market has a trend day on the first day, and then it manages or fails to even attempt to break out of the previous day's range and settles with an inside day inside the previous day's range within the top quartile of the first day's trend. The third type of example is whereby we have the market trending on day 1, the market then opens again on day 2, shows initiative through the highs of the previous trend day's high, and continues again for the second day of trend. These are the 3 basic patterns that you will see on the second day after a trend day. Now, what's important to understand is that when we have a fundamental that's created the trend day, it's highly likely that we get a second day of trend. However, when we get a more technical trend play, you're more likely to see the variations number 1 and 2. Now let's discuss what effectively creates this idea of a day 2 trend or a distribution the day after a trend day. Now, it comes down to something very simple, which is when we have a trend day, we know that we have an initiative move in the market. Now, what occurs on day 2 is not necessarily that there's a lack of, in this uptrend example, not that there's a lack of buying, it's just there's a real lack of commitment to commit to being long at the extreme or at excessively high prices. And as a result, what tends to occur is we get a little bit of momentum through the previous day's extreme. A lot of short-term algorithms and day traders tend to buy through that extreme, as there are very often some short-term stops above the previous day's high. But once the market fails to sustain the momentum above the previous day's high, we then see the distribution occur and some profit taking ensue from anyone that is still long. As a result, obviously, the market then rotates lower and we form a sideways market or a distribution. Now, some of the trade setups that you can expect to find, the 3 major trade setups that you would want to take on a day 2 trend are as follows. First and foremost, we look for a retest of the previous day's high. Now, this is probably one of the highest probability trade opportunities, and simply put, if day 1 is a trend up, the probability of us retesting the previous day's high, or at least extending it, is extremely high. So what you have to ask yourself very early on in the session is, what is the trade location, or where are we trading relative to the previous day? If we are trading relatively close to the previous day's high, again, the reward relative to what it could cost us is quite high. However, if we are trading in a much better trade location where we may see some early initiative taken from buyers, that then is a much higher probability trade location. The second type of trade opportunity on this day 2 trend would be for a distribution type play. So in this example, we want to watch very closely what occurs on the previous day's high. Once we take out that high but fail to sustain higher prices and fail to sustain the momentum, once we re-enter the previous day's range, we can then execute short side trades looking for a distribution type play. In terms of managing risk, we merely put our stop above the point which would prove this trade wrong. Now, the key thing to understand with regards to the second trade setup is that we are going against the short-term trend. Now, as a result, that means that we do want to be making sure we manage our risk effectively, but also ensure we don't look for too much or too big of a target. Then, the highest probability trade opportunity on day 2 after a trend is the probability of an initiative wave. So what do we mean by this? Well, in the example of an uptrending market, at some point over the course of the day, the market is going to pull back potentially to a point where we will see a wave of initiative buying occur. Now, if you go through a number of day 2 trends, you will see over a period of the day, there is one point in the market where we do see this initiative wave. Now, why this occurs is very simple. On day 1, we have a trend day. Now, a lot of people do miss out on this trend and don't manage to get on the trend. As a result, they're not willing to commit to higher prices, but they are willing to commit to any kind of a pullback. And that is why on a day 2 trend, at some point we get an initiative wave. And it's that initiative wave that creates for us a very strong trade opportunity. Now, the key to interpreting that initiative wave is we want to see a sudden shift in the volume and the volatility within the individual TPOs. I will show you in a bit what this example looks like. Now, what is key to understand also in the execution of this initiative wave is any momentum against the trend. So if at any point as the market pulls back, as in this example, we see a little bit of initiative or momentum against the trend, that gives us almost perfect price entry. Why? Because we should not be seeing momentum against the short-term trend. So that would be a key entry, and again I will show you as we go through the next couple of slides what this may look like. Now, just one thing to interpret with regards to the expectation analysis and emotions. Remember, the psychology of traders the day after a trend day is that of they've missed a particularly good move in the market. So what we do tend to find is that traders become a little bit relaxed the day after a trend when it comes to their risk. So it is imperative that you just watch and be patient with regards to this trade setup. Don't be caught out trying to look for the low probability trade, which is a second day of trend. Make sure you're patient on your execution. Don't be looking to be buying in bad areas. Rather wait for that pullback where we might see an initiative leg in the direction of the short-term trend. Now, let's move on to what some of the examples might look like. So as you can see on your chart, the first example, we have a trend day on day 1. Now note how the market extends on the previous day's high but leaves a relatively aggressive selling tail above the extension of the previous day's high. It then comes back inside the previous day's high, rotates towards the low before settling in the top half of the previous day's trend day up. Now this is very typical, the most common day 2 type pattern you're going to see. Let's have a look at some of the other examples. So in this example of the WTI NYMEX oil, if we look at the individual rotations, notice how very early on in the day the market sort of rotated a little bit lower but then gave us that initiative leg. Now the key to this initiative leg is notice the sudden shift in volatility in the X, the Y, and the Z time prints. As we can see, if we were patient for this market, we got a little bit of momentum against the trend. So notice the S print against the trend, opened, sold off, but rejected very quickly, leaving what we would call a hidden tail. That hidden tail is our initiative and our signal for an entry point for longs. Note the market gave us the high likelihood retest of the previous day's extreme. Then notice how the market showed us momentum against the trend, giving us a second potential opportunity for long side trades. Again, also notice once we did obviously extend on the previous day's high, we failed before creating that downward move. So that would again give us that second potential opportunity for the fade opportunity. And lastly, again, notice we had a very, very aggressive sell side price response, much higher volume, and a substantially large candle, which gave us the third opportunity for a long back towards the highs. Now the key to this, as you can see, is that there are 3 basic elements. Firstly, there's a high likelihood we retest the previous day's high. 2, there's a high probability we're going to extend on the previous day's extreme, but also potentially fail, and that gives us the second opportunity. And 3, the market is likely to give us an initiative wave with the short-term trend, and we need to ensure that we take advantage of that as well. Those are the 3 kind of plays you would expect to see in the day 2 trend. Let's take a look at another example. As you can see in this example, the Eurodollar FX, again, notice how we extended on the previous day's low. Notice how if we go to the individual auctions, we can see how the market sold off and retested below the previous day's low, giving us our first opportunity. Our second opportunity came back inside the previous day's range. It did test higher but failed. So note in this example, it did not pay us to take on this trade as we would have been stopped out. More importantly, however, we did get the opportunity again to enter our shorts as we retested the previous day's low and the market held lower. So again, not quite picture perfect as the 3 examples I've given you, but again, the basic premise of the trade idea is there, and that is the key to this trade setup. Let's now move to our last example. as we could see again in the euro dollar, notice how we had the inside day after the trend day. We then had a second inside day. Again, in this example now, see how the market doesn't even manage to retest the previous day's high. However, it does give us the initiative leg as well as obviously the momentum into which we could get long. That then concludes our series of the day 2 trend and the 3 examples you can expect to see. Let's now move over to the replay series where we can watch the live execution of the various types of trade setup. So welcome back to the replay series for number 8 in our strategy of 11 unique strategies. We're going to be talking about day 2 trend. Now, this is a fantastic day type, a fantastic strategy, and the simple reason why is because it's the day after a trend day. In other words, you can identify a day 2 trend strategy and have a lot of time to think about how you're going to execute, what your rules are going to be as to how you're going to execute, how you're going to manage the trade, and so forth and so forth. So it's a wonderful opportunity to really, make some really good, easy money by identifying just some really good, smart execution. So let's get straight into it as to how we're going to, one, identify the strategy and execute and manage the strategy. Now, the first thing to understand about day 2 after a trend is that when there is a trend day in the market, by definition, we know that there's very strong initiative that has taken place the day before. So we've seen all time frame participants, getting into the market, getting into the same, direction of the market, and we've seen a market move aggressively either to the upside or to the downside. Now, the important thing to understand is that the psychology of traders after a trend day is very unique compared to normal situations. Now, the reason is very simple. Okay, firstly, let's say a market has very aggressively trended to the upside. Now, what you've got to bear in mind is that, one, as this market has moved higher and higher and higher and higher, anyone that's short has had to stop out and stop out and stop out and stop out. Equally, as this market has moved up aggressively, a lot of longs have failed to get onto the trend. So not only have we seen some shorts being stopped out of their positions, but we've also seen longs unable to get onto the trend. So straight away, as you're coming into day 2, there is a lot of confusion and nervousness surrounding day 2. And what I mean by it, in other words, anyone that failed to get on the trend the day before now feels that maybe they don't want to be too aggressive, they'd rather wait for a pullback. And equally, anyone that was trying to short the trend and not quite seeing what was occurring, they've taken a lot of substantial losses on the short side, and so they're also a little bit tentative to short it or get onto the long side. So there's almost a complete disbelief in the trend, and it's that disbelief that gives us the opportunity and the characteristics I'm going to show you in a minute. Now, some of the key things to understand before we go into the actual characteristics is the potential day types you could see. So there's 3 very specific day types you're going to see, and they are as follows. So first and foremost is where we have the traditional hangover day. So let's say this was our previous day's trend day. A hangover day would typically be where the market stays well inside the previous day's range, but within the top quartile, or in a downtrend within the bottom quartile. So that would be our first example. Our second example would again be a form of a hangover day, but we would at least extend upon the previous day's extreme. So a little bit something like that, or to the downside, a little bit something like that. And in the third case example is where the market opens and we trend and trend again on day 2. So those are the 3 unique strategies you will see and need to employ on a day 2 trend. Now, the important thing to understand is that there are very key characteristics that you will see early on that will identify which one of the 3 of the day types you are going to likely get. Now, remember what I said to you in the beginning. This trade strategy requires utmost patience. It requires understanding of what has occurred in terms of the psychology of both buyers and sellers in the previous session. If you can understand the strategy from that perspective, you will very quickly realize that patience will pay when it comes to day 2 trend. Now, the first thing we're going to deal with is some of the characteristics you will typically find on this day type. Now, the market example that we're going to use is the Euro-Dollar FX, and the day type that we are going to discuss is effectively the inside, the inside day. Now, remember we noted that that was where the market fails to break the previous day's high and remains within the top quartile. Now, to bear in mind, put things into context, in the Euro-Dollar, the previous day we had a relatively aggressive trend up day, and the market topped out at 108.80. So that was our high from the previous day, and that is where we're going to pay attention to firsthand. Now let's roll the tape and let's have a look how we can define some of the characteristics, execute and manage this trade opportunity. Now the first thing you need to know about the setup in terms of trade opportunity, let's pause that for a second. The first thing you need to know is that trade opportunity number 1 is that there is a high probability for a retest of the previous extreme. In other words, if the market trended to the upside as it did in this example, or to the downside as in some examples, there is a high probability we will retest that extreme very early on in the session. Note what I said, it's very early on in the session. So what you want to pay key attention to, and what you find particularly with the currency markets, is that if in the Asian session the market has failed to test the previous day's extreme, once the European session comes in online around 8 o'clock, there tends to be a high probability we retest the previous day's high early on, as in the example we've provided. So very important to understand, our first trade opportunity is to determine, have we retested the previous day's extreme? More importantly, if we take on that trade strategy, what location are we taking it from? And that is crucial, guys. Very carefully listen. If we are, let's use a nice little example. So this is the previous day. Let's say the European session opens and we're opening, let's say the range between, or the distance from the high to where we're currently trading is 20 pips. Okay. Now what you have to say to yourself is, let's say the previous day's range was 200 ticks. So what you're saying is, in terms of trade location, are you being too aggressive on a day 2 trend? Now, again, this is all relative, but what I would say to you, the key to taking on this first trade opportunity is to say to yourself, if you are executing in a good trade location, in other words, if you are being a buyer in a good area, in other words, the market has had a somewhat of a pullback, if you are executing in a good area, you are allowing yourself to take advantage of the high probability that we're going to retest the high. So trade location is important when coming to this first setup. If you are buying, for instance, 15 to 20 pips off of the previous day's high, you are being a little bit too aggressive based on trade location. So trade strategy number 1 is all about trade location. Now, that's our first opportunity. So let's see how this trade played out. I'm going to roll the tape back a little bit so we can see how it played out. So note now the European sessions opened up. We're trading around the 107.45. Remember, bear in mind, our previous day's high is 108. So we can straight away see that we are 55 pips below the previous day's extreme. So straight away, if I was trading this, I'd look at this and say, well, if I can get a good long off in a good trade location, there is sufficient upside, a minimum of 40 to 50 pips, which I can partake in. Now note, I said to you, in the 3 examples, 1, we have a hangover day inside the previous range. 2, we have a hangover day which just extends the previous day's range and fails. And 3, we have a trend day. Now again, note, in terms of probability of outcome, we are least likely to see a trend day, whereas we are most likely to see an inside hangover day. So again, work within the probability. If the probability is very low that we're going to have a trend day, well then don't be looking to be too aggressive at the previous day's extreme. Likewise, if there's a high probability that we could at least retest the previous day's high, then we want to be executing aggressively on a pullback early on. Now, as you can see in the tape, notice how the markets very early on decided to go in and retest above the previous day's highs. And note the little bit of distribution. So we can see the market opened, moved from 45s all the way up to 90s, and now we're seeing two-way trade between the buyers and sellers. So an early retest of the previous day's high area, we can see that not only have buyers backed off their first time, but we've also seen a little bit of response from the sellers to step in. Now, let's just move this a little bit forward and see what happens when we retest, note, the crucial previous high of the day. This is the key area that you want to focus on, guys, is the previous high. In this example, in a downtrend, the previous low. So the previous high will unlock a lot of information early on as to which one of the three day types you can expect. Failure, and it's all about the hangover options. Success and aggression and initiative above the previous day's high, and we could have the potential for a trend day. It's that simple, guys. We've got an early execution looking for the retest of the previous day's high if we are in a good location. 2, what do we do at the previous day's extreme, whether it's the high or the low, as that will determine whether or not we are going to trend up for the rest of the day or continue in a hangover distribution day type. Now note how the market is very early on distributing. We saw a little bit of buy side action early on, and we then distributed before the market now sold off and has now done the entire day's range. So straight away you can see that there was a lot of reluctance for this market to hold on to higher prices, and now it looks as though it's going to be distributing. So straight away we rule out the idea of trend and we go into full scale hangover day. Now trade opportunity number 2, which is very, very key, is looking for, again, we're looking now for a price response in the direction of the trend. Now I'm going to show you what I mean by this. In other words, so let's say the previous day we have a nice trend up day. Now, what we're looking for is as this market comes lower, let's just change this color, as this market comes lower down the page and slowly drifting into the previous day's range, the moment we get some very aggressive, responsive buying, okay, the moment we get that responsive buy-side price action in the market, where we see, some tail, some initiative, maybe some hidden tails, or some real aggressive reversal price action, at that point, we want to look to execute aggressively, looking for the market then to rotate with the short-term trend to the upside. So what we're looking for is any kind of momentum to the downside that we can get onto. So the minute we see any momentum counter the short-term trend, bang, that's when we want to get involved, and that's when we want to execute and put our stop below that point where we enter and we see that aggressive type reversal price action. Now note, as you can see on this day type, remember, it's day 2 trend, we are within a short-term uptrend. Notice how the market has got 2 unique distributions. So almost like a double distribution. So straight away you're going to say to yourself, how can a market that is relatively aggressively bullish to the upside, how can it start leaving all of a sudden a lower traded volume area when the trend is to the upside? So again, a very early identifier, but remember, some of the key characteristics to pay attention to on a day 2 trend is that 1, we see a lot of two-way trade. Okay, so expect a lot of two-way trade, expect a lot of overlap trade. And you can see that if you look in this portion here, look how much overlap is occurring between all the TPOs. So straight away, in day 2 trend, expect the two-way trade. Don't expect too much aggression. Don't expect to be paid for being aggressive. Okay, as a rule of thumb, on day 2 trend, you always want to be aggressive with the trend, and you always want to be passive counter trend. So what do we mean by that? In other words, if you want to short this market, that's fine, but don't short in here. Okay, you short in there, you're taking on a lot of perceived risk. right? If you want to be short, short passively. Let the market come to you and give you short side opportunity. If you want to be long on the aggressive side. So bang, we could see this momentum coming in. Bang, bang, bang. We look to buy, buy, buy. Be aggressive on the buy side. Why? Because it's with the short-term perceived trend. Now note, let's pause this there. What's happened here? We can see that the market has been distributing. We've had a double distribution day type, and all of a sudden, so we've had a double distribution day type, and all of a sudden, we can see the market has shown momentum counter trend. Now remember what I said to you. Strategy number 2, the minute we get a price response in the direction of the trend, it's once we see these buyers step back in, we want to look to execute long, aggressive long trades, playing for a move back towards value. So as we can see, the E print came lower, we saw aggression, the F print came lower. All of a sudden, we get a little bit of a buying tail, we get the inside candle with the G print, and we suddenly start making a series of higher lows before the market looks to rotate back towards value. Now remember what I said to you, in the second trade opportunity, the key is to be willing to hold on to the trade with our stop below the point where the initiative is taken. More importantly, we're looking for a relatively large move. In terms of target, we don't want to be getting out of this trade until the market has paid us what it is worth. In other words, if this was, because this is with the trend, we would expect the bounce on this to at least return back up towards where, we were previously accepting value. So again, just putting yourself in this mindset that you are with the trend, that you are deserving of more, will allow you to stay in the trade a lot longer. So that is our day 2 trend. It's a wonderfully simple setup, and if you're patient with it, if you really just take the time to think about the setup and the psychology behind what's occurred, you're so likely to be more patient on these day 2 trend days. So let's just recap. The 3 strategy or the opportunity is very simple. 1, we're looking for an early retest. That's step number 1. Step number 2 is that we want to determine what day type it's going to be. So again, in order to determine the day type, we watch the previous day's extreme. Okay, and number 3, we're looking for the initiative or the momentum counter the trend to take on fresh aggressive trades with the short-term trend. That is our structure. That is the characteristics, the execution, and the management process you would take when executing upon day 2 trend strategies. Now, I hope you've enjoyed this strategy. It's a wonderfully simple strategy with really basic understanding and basic execution. Now, the objective for you is to go and find this trade strategy in the markets, okay? We see trend days, a lot of the time across various markets. Now, it's up to you to go and find these day 2 strategies and make sure you learn them and learn to execute and profit off them. Remember, guys, practice makes perfect. Welcome to the final of our trending trade strategies. That is the engulfing profile and engulfing value area. Now, before we get into the specifics of this trade strategy, let's just discuss a few of the key characteristics behind why trending strategies not just work so well, but why we can, particularly do very well in them. Now, the first thing is to understand is that when the markets are trending, we are merely out of balance. So, by definition, when a market is out of balance, it's forcing various different time frame participants to respond to the change in prices. This change in prices is what presents the unique opportunities for us. Now, one of the key things to understand is when markets are trending, they tend to catch a lot of people off guard, and they tend to test a varying amount of skills. In other words, if you are used to day-to-day trading where the markets, distribute and don't move too aggressively or in a volatile manner, you have a tendency to develop various types of skills. So when a trending day comes along, this happens to test skills that we are maybe not used to utilizing day in and day out. And that is why, trending days, whilst they are wonderful, they do tend to reward those that are best prepared and that have got the best skill set. Now, one of the things to understand is that, you know, the trending day or the day after a trend day, it does present unique opportunities, as you've seen in the day 2 trend and as I'm about to show you in the engulfing profile and value area. However, it only rewards those that have got a firm action plan and that are prepared to execute based on the way or based on, you know, the manner in which the market is likely to present itself. Now, one of the key things to understand when we talk about the money management of trend days is that you need to accept that with wider rewards or wider probability or possibility of making money, you need to have a wider probability of also losing money. So make sure, you know, when you do go over your you know, various execution styles, make sure that you interpret and understand, you know, that you do require slightly wider profit targets as well as wider stops. With that in mind, let's get into this trade strategy and discuss all the various opportunities. Now, first thing to understand is what an engulfing profile is, or an engulfing value area. Very simply, an engulfing profile is where, as per the example, the previous day's profile is completely engulfed within the current day's profile. Now, the key to understanding the word or engulfing is to understand that engulf does not imply trend. And this is a mistake I see a lot of traders making. They tend to assume because we've had an engulfing day type that the next day ought to have some form of trend. What I would say is this is factually not correct. What is correct to say is that engulfing equals volatility. Now, knowing this puts you in a particularly powerful position. So what I'm trying to say, as you'll see on the next chart, is when we do get an engulfing day, the likelihood of wider, you know, rotations in the market and the market moving from A to B relatively faster, that is much higher, and that is the key to understanding how to execute, you know, an engulfing, or the day after an engulfing profile or a value area. With that in mind, let's just quickly discuss what an engulfing value area is. Very simply put, if this is the previous day's range with the lines depicting the previous day's value area, on day 2, the market again overlaps, quite a lot of overlap trade, but the value area of day 2 completely engulfs the value area of day 1. Again, by definition, this engulfing does not imply you know, trend, but merely volatility and potential for larger rotations. Now, the key strategies when developing the engulfing setup are as follows. Firstly, we have the retest. In other words, when we have an engulfing day type, the next day the probability of retesting the low is quite high. So again, we can see that if we have an engulfing toward the downside, the probability of retesting this low is relatively high. However, in terms of execution, we do want to ensure that we are executing at a good trade location. The second strategy would be looking for some form of a continuation. So again, in the example, we'd look for the open and a breakdown of the previous day's extreme and the potential for continuation. Now, in this example, what's key to understanding with regards to the continuation is what happens at the extreme. Now, one of the best ways to determine whether or not there's a probability for extension or not is to determine whether or not we get initiative on the break or not. So if there is flow, momentum, volatility, and some strong control identifiers on the break of the previous day's extreme in the direction of the engulfing candle, this is very suggestive that we could get a relatively aggressive continuation type move. However, again, if we fail to extend on the previous day's low and cannot sustain the break, we could likely see a relatively aggressive move in the opposite direction, as we expect to see an unwind of the short-term positioning. Now, one of the key things in terms of you know, going forward in terms of the execution is how we execute, and I'm going to show that to you in the slides ahead. what is important to understand is, what actually creates the engulf, because this will give us a good idea as to the potential for opportunity. So an engulf can be created by a number of factors. The first reason would be a position unwind. Now, as you can see in the example provided, the market was clearly relatively long on the day. We then had quite an aggressive up move. The market returned back to the original area where the initiative took place, and then completely unwound all the long positioning. This is the first reason for an engulfing candle. The second reason is for an aggressive positioning on a shift or change in the fundamental picture. This simply means that if, for instance, the market's trading, we happen to get a key piece of data or something that creates the volatility for a shift in prices, longer-term institutions step in and take advantage of the sudden shift in prices, but not only do they return prices to where they begun, but they continue to initiate. Let's now take a look at the example and open up this profile and see how this day played out. Now, key to understand that is when we have these engulfing day twos, you need to be relatively passive on your execution. So in terms of the execution, one of two things can happen on the break, as you can see by the blue line in the chart. Now, once we break below that blue line, like I said, you need to determine whether or not we get some form of initiative or if there are any kind of control identifiers. Now, as you can see early in this example, we saw some initiative being taken. For all intents and purposes, this market could have continued quite aggressively to the downside. However, we then saw the momentum disappear and two-way trade ensue before the market continued to just slowly drift lower and lower over the course of the day. This is very typical in a day two trend, and the reasoning is quite simple. What tends to occur the day after an engulfing day is we tend to see quite a lot of management of positions. What do we mean by that? Let's say, for instance, day one happens to be engulfed by day two. Now, on day three, we have to bear in mind that the very people that created the engulfing move were the longs that were caught out of position. Now, by that definition, the market is now turned net short. So what we have to ask ourselves is, given the extent of the move or the sudden relative change in the price of this market, are there going to be willing shorts that are willing to execute very aggressively at the engulfing day's low? And the simple answer is highly unlikely. Whilst it could occur, it is unlikely. And it's for that reason that we tend to get, as you can see in this example, a more grinding type price action as opposed to an aggressive initiative type price action. Now, the key to understanding this is that if we are going to, trade this day type and the strategy, we need to be willing to be more passive on entry once we break below the previous day's range. What do we mean by that? Every time the market goes back bid and tries to rally, we want to be selling into weak rallies, looking for small extensions. And again, selling into rallies, looking for small extensions. This is the basic methodology you would utilize to executing the day to, or the engulfing value area and engulfing day. Again, the last example, as you can see, is the engulfing value area. So again, note on day one we had the value area, day two's engulfing value area, and day three we suddenly open, we show a little bit of volatility, but ultimately we just get range expansion. So don't forget, in summary, engulfing does not imply aggressive trend, but rather it implies a bit of volatility. That then concludes the final of our trending type strategies. I hope you've come to understand some of the characteristics and fundamentals and principles behind not just why these strategies are highly effective, but why they're so important to learn and add to your playbook. Let's now go and have a look at the replay functionality of the engulfing day type and see how we can execute based on the various principles and characteristics. for the final in our series of trending trade strategies. That's strategy number 9, engulfing profiles and engulfing value areas. Now, first and foremost, the important thing to understand is that an engulfing pattern, it has a lot of similar attributes to a day 2 trend. And again, it reverts back to the psychology over what has occurred in an engulfing day type. So I think the best way to sort of start and illustrate this is to just draw the 2 types of engulfing profiles and value areas you can expect. So the first one, which is also in candlestick terms, would be an engulfing candle, or a complete where the next day's candle completely ranges up the previous day's candle. Now, in terms of profiling terms, let's say that was our day 1 volume profile, and on day 2 we completely engulf the range of day 1. Now, this would be considered an engulfing volume profile. In terms of the second option, which is an engulfing value area, similar, except this time it's more the value area. If this is our value area low and our value area high, in this instance, we can see if that's the value of the previous day, the next day our value area completely engulfs the previous day's value area. Now, the important thing to understand about this trade strategy is, what does engulfing mean? Okay, the important thing is that engulfing means nothing other than volatility expansion. So what do we mean by that? In other words, in order for the market to have engulfed the previous day's value area or the previous day's range, we've seen a pickup in the expansion or in volatility expansion. In other words, the market's ranges are now substantially different to what they have been. Now, this expansion can be caused by 2 reasons. Firstly, it can be caused by a sudden shift in market perception. In other words, suddenly something big has come out in the market, and the market has had to move aggressively from one direction to another. The second reason is that we've had a huge positioning unwind. In other words, there's been, the market's moved in one direction, and all of a sudden, some real initiative has been taken from the other influential time frame participants, and they've moved the market not just beyond the initial parameters of the day, but well beyond in the opposite direction as they take advantage of prices. Now, those are the 2 types of volatility expansion that occur. Now, again, the important thing to understand is that when you see this engulfing day type, it's very advantageous because you have an entire couple of hours to plan and prepare as to how you're going to execute the day after an engulfing profile and value area. Now, if you want to be successful at this trade strategy, you've got to follow a very unique step-by-step process. Now, first and foremost, just bear in mind, when we get volatility expansion, all this implies, it doesn't mean necessarily that we're going to trend. And I think that's a big mistake a lot of traders make. Volatility expansion does not imply trend. What it does imply is that we get much larger, non-directional, all-directional moves. In other words, if suddenly you get an engulfing day, there is a high probability that you're going to get continued range expansion. More important, if you are used to the rotations in your market being, say, 10 prices and then 10 prices and then 10 prices, you can now expect that to double or even triple to doing maybe 20 and 30 and 40. So you get much bigger rotational moves in the market as a result of the engulfing nature. So that's important to understand. Now, when we go through this trade setup, there's a few key things and key characteristics that you want to pay attention to. First and foremost, you need to identify the previous day's close. The previous day's close is pivotal. If we close beyond the range of, in the example of an engulfing, profile, if we close beyond the range of the previous day, in other words, if that's our profile, and we close either above or below the previous day's range, that is relatively a strong signal as to early sentiment the next day. Note what I said, early sentiment, not necessarily early directional play. So again, when you see this day type where we get an extreme type close, there is a very high probability that the market will at least test the previous day's extreme within the very early opening time frame of the market. So again, the close is important. In terms of the engulfing, value area, again, similar. If the market closes somewhere on the extreme, an engulfing value area, there is a high probability that we are going to retest, the previous day's extreme based on where that closes. So that's the first important factor to take into account. Then the second important factor before we get going is to identify the price response when we retest the previous day's low. Now, as we go through this example, I'm going to explain to you the characteristics and the execution style based on the various strategies. So first and foremost, you can be sure that if you execute, in other words, if we have an extreme close, as we did in this example, if we were to illustrate this, if I can bring, in fact, let's pause this and I can bring you into context. So what happened on the previous day was we effectively, the market opened relatively, sort of neutral. We then attempted to move aggressively higher and the market very quickly moved back lower before settling down, distributing and then distributing twice. So a very, very, very aggressive sell-off off the top. The market showed some real initiative once we tested, that high point. So again, we saw some real strong initiative taken from the sellers. More importantly, we then settled and closed towards the low. So let's continue this now and see, what the market does in the early, attempt. So as we can see, the previous day's close was the 109.55 with a low print of 109.40. Now, as you can see, the market's opened in and around the previous day's low, and it's distributing. It's looking for a lot of two-way trade. Don't forget, when we do open around the previous day's low, outside of the value area, we are in effect opening out of balance. So the market is a little bit skewed in terms of its balance. Now, the first and most important characteristic to understand is the break of the previous day's low. Okay, so the break of the previous day's, or not necessarily low, but previous low or high, is the key in determining what sort of a day type you are going to get. Now, if we get an initiative break, so we get an initiative break where we get single prints and a low volume area and real strong aggressive like we're seeing here. Okay, if we get that initiative and the initiative holds, then there is a high likelihood that the market is going to continue with the short-term trend and you can be relatively aggressive. However, this is not the highest probability outcome. What usually occurs the day after an engulfing profile is we usually get a drift type pattern lower. In other words, the market takes out the previous day's low, it extends, we then get a rotational move and an extension and a rotational move and an extension and a rotational move. Now, there's a very important reason as to why this occurs and why it occurs so often. Now, again, it reverts back to the psychology of what has occurred the previous day. So cast your mind back to the previous day. We had a move up and the market very aggressively, sellers stepped into the market, and more importantly, they forced buyers to liquidate. So buyers liquidated and buyers liquidated. Now, what you have to say to yourself is, we saw the initiative substantially higher from the sellers. Now, fresh sellers, initiative fresh sellers, are unlikely to be as aggressive going forward. Why? Because they've already positioned themselves short. In other words, what's taking this market lower and below the previous day's low is buyers that are liquidating or that are caught offside liquidating their position. So it's an unwind of the longs that got caught out as a result of the extreme volatility. And now, so what happens is whenever the market tries to bounce, we can see anyone that's caught long still tries to liquidate those positions and they sell out. And that is what creates the fresh leg lower. We then see a little bit of short-term reprieve as the buyers stop selling so aggressively, and we get a little bit of a bounce until the sellers then initiate again. And it continues over the course of the day. This is the most likely type of price response you are going to see after a day where we have engulfing profiles or value areas. So again, straight away you've got to say to yourself, if there is a high probability that this is the type of price response you're going to get, then you need to execute in a very specific manner. And that manner is simple. We do not want to be firstly looking to buy the market in this example, but more importantly, we want to be looking to sell into any kind of short-term momentum to the upside. That is the key. We don't want to be aggressive to the short side. We don't want to be selling lower prices, but we want to sell into any attempt at a weak up move, as we know there are a lot of longs that still, that are still trapped, that are still trying to get out, that will still keep executing on any move higher. Let's now turn our attention and have a look at how this played out on the chart. So as you can see, we initially took up the previous day's low. We got that little bit of initiative. So again, remember, we got those buyers paying out of those positions, and note the initiative. So we can see initiative, but again, this initiative isn't necessarily from new business, from sellers. It's more likely from buyers that are still caught out from the previous day trying to get out. Then note how the market distributes. So again, put yourself in the frame of mind of, if I was a buyer at this point, what would it have felt like? It would have felt uncomfortable. You would have had to sit there for almost 3 time frames or an hour and a half just for the market to start to rotate higher. Yes, it did rotate higher, but the key thing is that one of the characteristics of engulfing profile or the day after is that it's a more difficult trade to be on the wrong side. So if the short term or the engulfing was to the downside, we don't want to be buyers. Likewise, if it was an engulfing to the upside, we don't want to be sellers. Remember, guys, you want to put yourself into trade opportunities where you're going to feel the least amount of pain, where the probability of success is at its highest. Now note, we said we want to be aggressive when the market gives us momentum in the opposite direction. Why? Because we expect anyone still caught out to be aggressive. And you can see that once the market showed a bit of momentum to the upside, we can see how quickly that A print was reversed and we came back and started distributing lower again. So again, straight away in terms of execution, we want to sell into any short-term momentum to the upside. And then again, notice once the market found a little bit of, short-term reprieve and we saw maybe a little two-way trade come into the market, notice how difficult this trade would be for anyone long. Whereas if you were short, higher up or at this point, prices are continuing to hold to the downside. And this is the kind of price response, the kind of auctioning you can expect to see throughout the day type when you see, these engulfing profiles, or at least the day after the engulfing profile. Now, just 1 or 2 things to keep in mind in terms of characteristically. Note, when we have had an engulfing day type, the next day, you can see the market is distributing. This is nothing more than a normal distribution. Yes, it's normally distributing outside of the previous day's range, but effectively we are still just finding fair value over a wider range of prices. And that is the key, is that engulfing just means volatility, and volatility just means an expansion over the number of prices that we distribute. That is the key to understanding the engulfing profile and value area strategy, is you are going to get prices being distributed but over a wider range. Now, let's just fast forward this on and see what the day type looked as we get toward the end. Again, note, when the market does try to bounce, let's see what the opportunity looks like. So as we can see, the market eventually closed, but note it closed well within the lower bounds of the day. But ultimately, we had nothing more than a normal distribution, or a normal distribution below the previous day's range. So to sum up, in terms of execution, what we're looking for is the previous day's low. We want to see a retest of the previous day's low. Secondly, obviously we want to see how the market responds on the break of the previous day's low. Is there initiative below the previous day's low? Okay, if there's aggressive initiative and we see a low volume area and single prints and trend-like characteristics, then we want to get aggressive. But note, we do expect to see a lot of two-way trade. Why? Because we obviously know that the new business taking us lower is not necessarily, fresh selling entering the marketplace. So that's a summary of effectively what we've done and dealt with over the engulfing profile and value area. I hope you've enjoyed this final setup of the trending series, and again, make sure you go throughout the markets, go and find these day two or these engulfing profiles, and go and determine where are the best levels to execute at. How can you manage those trades effectively, and what are the key early characteristics that define those opportunities? Remember guys, practice makes perfect. Very briefly, what we spoke about in part 11 is we started with the, introducing you to the price ladder and some of the elements of the price ladder with the bid and the offer, and with the basic elements of the, auction process that takes place on the price ladder. Now, we spoke about some of the key advantages of being able to combine the price ladder with volume profiling, and some of those advantages listed. We spoke about, execution and how having the price ladder allows us to execute at best price. We spoke about management in terms of how, with a price ladder, we can make sure that we manage and enter and exit our trades, as we feel are best in terms of achieving the trade strategy we want to achieve. We then spoke about various strategies that you can execute alone just using the price ladder, and developing these strategies by watching the interaction between buyers and sellers. And then we finished talking about how we can perfect the 11 unique strategies I've dealt with, or I'm going to deal with in module 3. And we spoke about how utilizing the price ladder will allow us to absolutely maximize out of those 11 unique strategies and get the timing spot on. We then moved on and spoke about the trading secret, and I spoke quite in depth about the secret, and the key takeaway is, and all I'm going to do is sort of leave it at that, is it's all about the one good trade. It's all about making sure that at the end of the day you can just execute one good trade well, and if you can do that, you will be successful over the long run. We then moved on and spoke about our trending trade strategies, and we started off with the traditional trend day, which we said doesn't occur very often, but when it does, it can be particularly painful if you don't see it, but it can be also particularly profitable if you notice the characteristics which are dealt with you very early on. We then moved on to the day 2 trend, where we said, after a trend day, you still want to be switched on for day 2 because you get 3 unique types of patterns you can expect. And, we spoke about those patterns being, a hangover inside day, or a hangover failed break to the, with the trend day, or even a trend type opportunity. And we went through each one individually, talking about, where the characteristics are, where the entry opportunities and management styles are, and how you could achieve success with the day 2 strategy. We then finished our trending trade strategy series with the engulfing profile and value areas, and we said that an engulfing profile is nothing more than where a market opening up in terms of volatility, and that this volatility doesn't necessarily imply a trend, but does imply more opportunity as a result of the volatility. That is where we finished our part 11, and I hope you're really sort of starting to see the benefit of a lot of these trade strategies, and I look forward to seeing you guys back in part 12.
I really hope you enjoyed those trending strategies we went over, as well as the replay function. I hope you're starting to see now how effective the replay function can be in not just seeing how these patterns play out, but also how these strategies can really add a lot of value to your trading arsenal. So now, to make sure that you understand the principles you dealt with, we have our summary checker. Answer the following questions. What is the reason traders use price ladder strategies combined with volume profiling strategies? Then, what is the hidden secret to being a successful trader? And no, there is no such thing as a holy grail, but there is a secret.
And then lastly, define a trend strategy in terms of the following: time frame players, initiative versus responsive, time objective, volume and volatility, and risk reward. Again, make sure you can differentiate between trending strategies and momentum strategies, as well as anomaly strategies, in terms of these 5 key characteristics. Good luck. Welcome to Part 11 Playbook. As per usual, I want you to go and find the strategies, the trend strategies we've spoken about in Part 11, being the Day 2 trend, the trend day, and the engulfing profile and value area. And I want you to go and find those in the markets listed below. Again, don't forget to take your time. Really enjoy not just finding these strategies, but really enjoy learning them and finally grasping some real basic strategies that you can add to your arsenal and hopefully begin to become more profitable. Good luck, and I look forward to seeing you all in Part 12.